Gold is up over eightfold over the past 23 years, right? 8 times. The Dow Jones is up 4 times over the same time period. So gold has dramatically outperformed the Dow over that time period. But even if you just take eightfold again, right now we're at 2,500. So eightfold is 20,000, right? But I don't think it's going to take 20 years to do it. And remember, it only took gold 10 years to go from 270 to 1,900.
As the global economic landscape shifts, gold is once again capturing the attention of investors and analysts alike. PeterSchiff, CEO of Euro-Pacific Capital Inc., and founder of Schiff Gold, parallels the current gold price movement and the dramatic rise witnessed from 2001 to 2011, when gold surged from $270 to $1,900 per ounce. After a decade of sideways trading, Schiff posits that we are entering a new bull market for the precious metal. Recent market activity seems to support this view. Gold prices rebounded early Friday, building on Thursday's late recovery. This uptick is primarily attributed to the renewed weakness in the US dollar, particularly evident in the USD JPY sell-off and negative US Treasury bond yields. Despite a brief 1% correction on Thursday due to disappointing US economic data, the short-term technical outlook for gold remains bullish, with key support holding at $2,470. Schiff argues that this gold rally is intrinsically linked to the Federal Reserve's anticipated shift towards an easing cycle. The weakening US dollar serves as further evidence of this trend. Recent US economic data appears to be paving the way for interest rate cuts, with financial markets already positioning themselves for this move. The Federal Reserve's July meeting minutes revealed that a vast majority of policymakers agreed on likely beginning policy easing next month, lending credence to Schiff's predictions. This potential monetary policy shift could have far-reaching implications for gold prices. Historically, periods of low interest rates and quantitative easing have favored gold, as it becomes more attractive as a store of value when fiat currencies face inflationary pressures. Please tune in for our exploration of PeterSchiff's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
We've now closed 3 days in a row above 2,500. We set a new record high intraday today. I think we got above 2530 before we got a little profit taking in the futures traders, but we still closed at a new closing high on the day, very bullish. But the gold stocks, many of the big ones made new 52-week highs, but most of the stocks, lost a lot of their gain simply because gold didn't close on the highs. When gold pulled back, a lot of the gold stocks lost all their gains because the gold stock traders just don't trust the rally. They haven't trusted it all the way up. I mean, the whole move from 2,000 to 2,500, the gold stock traders have just really been against the move. They've been waiting for a shoe to drop and gold to crash. And so they reluctantly buy the stocks because the metal keeps going up. But there's not a lot of conviction there. There's not a lot of enthusiasm there. And I think that's typical in the early stages of a bull market. Gold has gone nowhere for so long now. It was gone sideways for over a decade that people have, given up on it. And people are very skeptical of the move. And I think that's very bullish because it really is another indication to me that we're going up, right? Because there's not a lot of people that are in the trade yet. And they will go eventually. I mean, people forget that before gold went sideways for a decade, it went from under 300 in 2001. I think we started this a century. Gold was about 270. And during the first decade, it went from 270 to 1900 by 2011. That is an enormous move. And so from 2011 till just this year, really, all we did is go sideways between 1900 and 1600 after gold initially pulled back to 1050 in 2015. Then it rallied back and it kind of just built a base. And what we've done now in 2025 is we've now started a new bull from that base. And it's not an accident that the rally is starting just as the Fed is preparing to enter the next easing cycle. Right? I mean, I think they've been easing for a while because they stopped hiking. And they already tapered back the size of their QT program. So that's already an easing that they've had. But They're about to cut rates in September. And I think by the end of the year, early next year, they'll be back at QE again. And so the gold market is already sensing this, and it's starting to move up. And the dollar, it's not a coincidence that the dollar index hit a new low for the last 7 months. So it's back to the January lows, and we're about to take that out. So you're seeing a weak dollar, you're seeing strong gold, all indicators that the Fed is, too easy and about to make a policy mistake yet again by cutting rates. I mean, not only should they not cut rates, they should raise them. Of course, the markets would react horribly to that. Stocks would tank. It would be horrible for the economy. But, that has to happen because the economy is a big bubble. Artificially low interest rates are a big part of the problem. And so normalizing rates are part of the cure, but, it's not a painless cure. And so that's why the politicians and the central bankers resist it and just try to come up with gimmicks to kick the can down the road so they can postpone the day of reckoning. And so most people, though, don't even know what's going on with gold. Even the financial media barely talks about it. They don't notice it. They still spend a lot more time talking about Bitcoin than gold, even though Bitcoin has lost more than 30% of its value priced in gold over the last 3 years.
In a striking display of resilience and growth, gold has significantly outperformed the Dow Jones Industrial Average over the past 23 years. While the Dow has quadrupled in value, gold has surged eightfold, cementing its status as a formidable long-term investment. This impressive track record has caught the attention of investors and analysts alike, with some predicting even greater heights for the precious metal. PeterSchiff has made a bold projection. Gold could reach $20,000 per ounce, representing an eightfold increase from its current price of around $2,500. While this forecast may seem ambitious, it reflects growing optimism in the gold market. This bullish sentiment is not limited to long-term projections. Wall Street is increasingly turning positive on gold as the Federal Reserve appears to be inching closer to interest rate cuts. Bart Melek, global head of commodity strategy at TD Securities, recently told Bloomberg that gold could hit $2,700 per ounce in the coming quarters, citing the prospect of Fed easing as a critical driver. Let's get back to the interview.
Gold is up over eightfold over the past 23 years, right? 8 times. The Dow Jones is up 4 times over the same time period. So gold has dramatically outperformed the Dow over that time period. But even if you just take eightfold again, right now we're at 2,500. So eightfold is 20,000, right? But I don't think it's going to take 20 years to do it. And remember, it only took gold 10 years to go from 270 to 1,900. A move like that, you're pretty close. But another way of looking at it is look at gold in relation to the Dow. Because if you look at the historic pricing of the Dow Jones, the bottom of bear market cycles in terms of real money, inflationary cycles, has been around 1 to 1, or maybe not quite 1, but 2 ounces to 1 ounce, where the Dow Jones is worth close to 1 ounce of gold. That's where it bottomed out in 1932, and that's where it bottomed out in around 1980, right? The Dow got close to 1 to 1. Yeah, well, because in 1980, gold got to 800, and the Dow got to about 800. That was, that's where it was. And so they're about 1 to 1. And so if you assume that we're going to get into an economic situation where you see the Dow Jones and an ounce of gold at roughly the same price, which, occurred twice in the 20th century, so it may happen in the 21st century. Well, the Dow is 40,000. How is that going to happen? How could they be the same price? Well, gold could go up to 40,000, they'd be the same price. Or Dow can come down to 20,000 and gold can go up to 20,000, they'd be the same price. Or the Dow could go down to 10,000, right? Or they could meet where the Dow goes to 50,000 and gold goes to 50,000. They could all go up, right? But as long as they get to about the same price. Now, my target is not really 1 to 1, 2 to 1 maybe. Somewhere between 2 to 1 and 1 to 1. I doubt it'll maybe get exactly at 1 to 1. But even if it was 2 to 1, if the Dow stayed at 40,000, gold would have to be at 20,000 for the Dow to be worth 2 ounces of gold. So right now it's around 16. That's historically high. I mean, it's not a record. We got up to like 40 to 1 in 2001, like at the peak of the dot-com. That was the record. That was the highest the stock market has ever been. But if you go back to 1929, that peak, the Dow was worth about 20 ounces of gold before the crash. and it went from 20 ounces of gold to 1 ounce of gold. So we're not that much lower than 20. I think we're about 16. So we're closer to the peak of the 1929 bubble than the bottom of the depression trough, 1932. So, there's a long way to go in where gold's ultimately going to go.
Adding to gold's appeal is the persistent specter of a possible recession. Economic uncertainties drive demand for safe haven assets like gold, as investors seek stability in turbulent times. Moreover, a recession would likely prompt the Federal Reserve to implement deeper rate cuts, further bolstering the gold case. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.